Interesting. Okay, let's move on and let's welcome on board Manish Gunwani as well and ask him about what he's making off the market right now. Manish, hi, morning. Great to be speaking with you as always. And Manish, we've been talking about this with many market experts that if you look at the index, it's a completely different story. But if you're invested in small and mid caps, your portfolio is looking a lot different. So it's best to not look at the index, not look at how your large cap banks and IT portfolio is done, but go very stock specific. Is that how you're feeling as well?
Yeah, long term, yes. But I think the valuation gap between a lot of large caps and mid caps has obviously become too high. The mid caps have generally done well, and some small caps as well. So it's not easy to get relative value by going into smaller market caps. Obviously, there are so many stocks that you can always like select small caps or mid caps. But I guess at least near term the valuation gap is quite high. And while the India story seemed to be improving a lot, this re-escalation in Iran war obviously tightens financials conditions for us. And I think the biggest challenge for global markets is the long-term bond yields. I mean, you have 30-year yield in US at 5.15 almost. I think that's going to tighten liquidity globally. So unless we see long-term bond yields globally come down, I don't think globally equity markets can go up too much.
Interesting. So, Manish, let's pick up on the large caps first, where you're saying that there is relative, valuation comfort. Where within large caps would you have that kind of conviction to put in fresh money?
No, definitely, it's a trade which doesn't work very easily, but the large private banks seem quite cheap. Actually, not only versus each other, but when you compare it to cement or utilities, they actually have become cheaper than a lot of other sectors on the domestic side. And I think large private banks is one. While IT services is a very complex thing because of AI, no one can predict what exactly is the impact. But I do think that the absolute downside is limited for a lot of large cap IT services companies. So it's going to be risky being massively underweight unless we again get some clarity on how AI plays out. So near term, I think it's not a great idea to be massively underweight IT services. Also because the currency seems to be weak. I mean, with all these FCNR flows, we're still seeing pressure on the rupee, which is a bit surprising.
Hmm. I get that point, Manish, but the currency has been weak for more than a year now, and that hasn't really aided IT in any which way. Is IT for you now only a valuation gap story, or do you see growth visibility as well?
See, basically, I think a lot of sector choices start with your view on AI, right? Essentially, the last 2 years, a lot of capital has moved to AI stocks. That is the first point. Second, the picks and shovels of AI, they have done well, whether it's power transmission or whatever. Now, if we believe that either because AI usage is lagging expectations which are built into these stocks, or there are execution issues like a lot of US states are banning data centers, or just the fact that the valuations are facing headwind because bond yields have gone up. So, for whatever reason, if we see a correction or a meltdown in AI stocks, I think IT services, the disruption narrative will get a breather, and maybe these stocks will do well because if AI rollout slows down, then the threat of disruption for some time kind of goes down. I'm not saying it's a 3-5 year call because in technology there's no point talking of 3-5 years. Um, but at this point, from a risk reward perspective, I think IT services look to be a neutral kind of call for us.
Okay. Hi, Manish. Good morning. This is Harsh also joining in. Manish, how is consumption looking at this point? Last couple of days, of course, I know you wouldn't look at markets from a 1, 2, 3 day perspective, but Nestle's numbers, things are looking up with regard to consumption. I'm trying to understand whether anything changes out there, given the kind of numbers and commentary coming our way.
No, definitely. If you see what has happened right across this war since February, the domestic economy and consumption in particular actually held up quite well. When you see four-wheeler numbers, two-wheeler numbers, FMCG numbers, it's been remarkable that in spite of high commodity prices, consumption has done well. And I guess even now, when you see the real-time economic data in terms of credit growth or tax collections or whatever, the domestic economy seems quite fine. But having said that, one should be a bit careful about, let's say, this oil price increase, which has happened again, because one should remember that in the first period from March to May, globally, a lot of strategic reserves were drawn upon, and the US reserves are down, I think, to mid 1980s level. Now, if you get extended period of embargo in Hormuz and this sustains, clearly this is a big risk to the global economy, and obviously India being a big importer of oil, this is a risk, I would think. So while consumption, as I said, has held up very well, we should not ignore that the more this disruption in oil supply goes on, the more the risk of a disorderly increase in oil prices.
And Manish, therefore, how should one place their bets if they were to place fresh bets on the consumption space, right? You've clearly highlighted the risks there. And you've also said that there's plenty of sector churn. It's not a market where one can buy and hold. That's the other thing that you said. How should one therefore play consumption?
So if I were to take a structural view of consumption, I would play the very premium end, right? Because when you look from the world from a 5-10 year perspective, because of two big reasons, one is demographics, that anyway, penetration-led stories are going to face a problem because even India's, at least in rich states, I think the population will peak out. And the second is the world generally is becoming a more premium consumption unequal place, partially because of technology creating some few big winners, partially because asset inflation has been high. So the if you see the household balance sheet of top 5 to 10% of any country, they are they've done very well because last 20 years, 30 years, the asset inflation has been quite strong. So premium consumption is what I would play on a slightly structural kind of basis.
Right. Interesting. Just looking at the market texture right now in the meantime, while of course there's DRL, which is a big casualty right now, IndusInd Bank as well, maybe a case of buy on rumor and sell on news kind of case playing out. Infosys as well is going weak into its numbers. HDFC Bank has fallen another 1% in trade. By the way, it's now sub 750 rupees per share. Nestle, after a very impressive set of numbers, the stock ran up as well pretty hard yesterday. Cipla as well soft, Bajaj Finance, Reliance Industries, all of these names are seeing a tad bit of cool-off play out. Having said that, once again, the broader end of the market is a completely different story. Look at Force Motors, that's up 3.5%, Nalco up 2%, Keynes up 2%, PG Electroplast 1.6% higher, and Novama as well, which is going very, very strong indeed in trade as we speak right now. But Manish, the other part of the market that you were addressing, the picks and shovels for AI. Tell me where within that pool, because it is a wide umbrella of layer 3 that India is providing as of now, do you still see opportunities where valuations have not already run up?
So I'm a bit cautious in anything related directly to AI capex. I think the better relative play is slightly broader based capital good companies, which cater not only to maybe data centers or AI led to a certain extent, but also for energy related capex like coal to gas or nuclear or stuff like that. Because I do think a lot of countries will do capex for energy security, right? Because whether it's Europe or India, we are energy importers. And after Ukraine and Iran, I guess there is more insecurity about the availability of energy, and you will try to build redundancies. So there'll be decent amount of capex, I feel. So I think some of the broader keep capital good stories probably a better risk reward. A lot of them are, let's say, 1 to 5 times sales, whereas if you see the AI stories, they're like 12, 13 times sales. So I would probably prefer the broader capex led stories rather than the very direct AI capex stories.
And how do you look at pharma, Manish? Does the story change structurally for you given this latest development around tariffs?
I actually think very low probability of that being implemented. So first of all, when you say 2 years from here, the current president will be almost on his way out because he's already finished. He'll be finishing 2 terms, so he can't come back. And two is, see, generic pharma feeds into the bottom 80% of population of US. When you are already hitting them with inflation, right? I mean, for US, the target inflation is 2%, but I don't think over the last 5, 7 years, at least since COVID, there's not been a single reading below 2%. So do you really want to increase prices of medicines which are used by the bottom half? So I don't think it will be at least implemented in the current form now. Instead of 100%, maybe 10, 15% will come, which will not be so much of a issue, I would think.
Interesting. Okay, Manish, great to have you on the show today. Thank you so much for joining in.
Thanks.